Hi, I'm Kevin Gormley, CFO with Leading Edge Financial Planning, and today we're going to talk again about our top 10 most common retirement mistakes. And today we're on number 9.
Number 9, all right. So
go ahead, Charlie.
So first I'll recap number 10. Our previous post there was, do not use the same investments and or investment style in retirement that you use in your working years. So that could create some problems there. So don't do that. Check out that blog post if you want more information on that. But today, number 9 is not understanding the tax advantages and disadvantages of different types of investment accounts. For example, traditional IRAs, Roth IRAs, 401ks, taxable brokerage accounts, and we'll even may touch on health savings accounts today as well.
That's right, Charlie. So typically, if you're going to get higher returns in finance, this is economics 101. If you're going to get higher returns, you usually have to take higher risk.
Yeah.
But we think the opportunity is so tremendous in avoiding taxation, and the word is avoid taxation. So there's a major opportunity here, and if you do this right, there's actually no extra risk just by being tax smart. So there's knowing, and then there's doing some planning. So if you can talk about those, Charlie.
Yeah, first of all, you've got to kind of understand, the choices that you have. Again, we kind of talked about a little bit already, but you have traditional 401ks, you have Roth IRAs, taxable brokerage accounts, and even health savings accounts. And the biggest things there that we talked about are that Uncle Sam's going to get his money either going into your account or on the way out. So first, you've got to understand kind of the framework and the fundamentals. And then secondly, like you said, it's not really like we've got to take extra risk to get this tax advantage, but we do have to take some time and we have to plan. So that's the hard part. It requires a little bit of planning, a little bit of time on your part.
Yeah, and probably the greatest benefit is that the software that we have available today can very quickly, you don't have to be a tax expert, but it can very quickly show the different tax advantages that you can get by planning intelligently, and some of the choices that you have as somebody that has a good amount of net worth and wants to go into retirement. So Charlie, talk about probably the most common scenario that you and I see, and that's that people just have a big IRA or a big 401k and they want to retire.
Yeah, exactly. And I was kind of going to piggyback on what you talked about earlier as a good transition, and that's the planning part. And the most common scenario that we see when we do planning, things like that, are folks that are either in retirement or they're getting ready to retire, and they have a 401k, and maybe a pension, let's say, for example. And that 401k is all pre-tax money, meaning they got a deduction going in. On the way out, that money is going to be regular income, as well as their, say, retired military pension or their pension from an employer. So now we have all taxable income, just like we did during our employment years. And so there's just no flexibility. In fact, they'll say, hey, I want to put a down payment on this house. I want to take out $100,000, for example. Well, now we got a tax problem, and we have no choices. We have no flexibility. And they ask, well, what can we do about this? Well, unfortunately, not a whole lot right now. But when we plan with our folks that are a little younger, for example, an extreme scenario, we start planning with somebody, let's say that's 40, maybe early, maybe even late 30s. We can really make some fine-tuning adjustments, some very small corrections that have huge impacts when they are next to retire at age 60, 65, whatever. So that's kind of what we see as far as the most common and what we would hope to see as the early planner.
Yeah, so what Charlie's speaking about is tax diversification. Now, you've heard about asset diversification to try to avoid loss. Well, what tax diversification means is to try to have some money in a taxable account, try to have some money in a Roth IRA or a Roth 401k, try to have some money in a 401k account. And when you're in the income producing years, many times people, they use a rule of thumb, that you should try to put all your money in a Roth or try to put all your money tax deferral. And what we're saying is that if you can create, when you retire, begin with the end in mind here. When you retire, have 4 different places to take money out of. You might be able to reduce your taxes in retirement.
So that's a great point, Kevin. And what we would like to do is be very specific with how we design somebody's financial plan and with taxes in mind when they retire. So the first bucket we'd like to create, which most of us have and we've talked about already, is that pre-tax 401k bucket or the pension bucket that they perhaps had from a previous employer or a military pension of some sort. The second one is our favorite. That's the tax-free bucket, and that comes from usually the Roth IRA or the Roth 401k. Sometimes that's hard to get money in there because there's limitations by the IRS on income and limits per year on how much you can put in there. The third one is the taxable investment bucket, basically, and that's probably the most overlooked because people say, well, I don't get a deduction, I don't get a deferral, and I don't get benefits coming out when the money comes out. But there are some there. We just have to be a little more thoughtful about it because we can use certain investments that are very tax efficient, such as exchange traded funds, ETFs, or index funds, or dimensional funds, DFA funds, are very tax efficient. So essentially, we create our own tax deferral there. And then when that money comes out, it's at capital gains tax rates, which are usually much, much less than the income tax rates that you'll pay. Finally, the fourth bucket we mentioned earlier a little bit is possibly health savings account. Now, not everybody has access to that. It's not appropriate for everybody, possibly, but that's a real nice one where there's been a lot of studies lately that show having that health savings account bucket, and that's the only one where money goes in tax deductible, lowers your income, reduces your taxes. It grows tax-free, which means it grows a little faster usually, and then finally can come out tax-free if you use it for qualified medical expenses in retirement. And even if you don't, if you're age 65, it acts like a regular traditional IRA. So that's what we like to design if we can, if we have enough time, if somebody's able to do that. And that's ideal, an ideal situation.
Absolutely. And I'd like to talk about what Charlie was talking or alluding to about the taxable account. Now, one of the things that we see from a behavioral finance standpoint is that many clients have money in different types of quote unquote retirement accounts, and then they have money building up in the bank. And they just don't think about the taxable account as being a place to put money for retirement, because it's not a designated, and we could actually name it anything you want. We could name the account retirement account if you'd like to. But when you have money in this taxable account, it's really critical that you understand the types of tax properties that investments have. And if you don't understand, you don't have to learn all about the tax code. We don't want to teach the tax code, do we, Charlie? But if you have money in a taxable account, you really care about something called asset location. It's a fancy way of saying what type of tax do you pay on the type of income that the investment generates. So for example, government bonds, they are fully taxable. So they would go to your highest tax rate plus any other super bonus surtaxes. Dividend paying stocks, the dividends actually are a lower tax rate than what I just talked about with the government bonds. So you really want to make sure that you have the right assets in the right types of taxable accounts, even in retirement. So while you're accumulating them, and then even in retirement. And the reason why a taxable account can have tax deferral, as Charlie mentioned, is if you have investments that don't have tremendous amounts of income, these things can grow and grow and grow, and then you don't pay tax on them until you sell them. And so that's the tax diversification that Charlie was talking about. So finally, we understand tax, we understand the types of investments that produce the certain types of tax, and that is a core recommendation that we have for clients, where to put what types of investments. So we very much appreciate you watching this series. We appreciate any feedback that you have, and next week we'll come out with the 8th most common retirement mistake. Thanks very much for watching.
Thank you.